A lot of Canadians have built their nest egg through real estate, and for a long time, it works. But then something shifts. The portfolios get bigger, the properties get harder to manage, the tax bill grows, and what once felt simple starts to feel heavy. That's usually the point where people start asking a different question. Not, is real estate a good investment, but does this still make sense for me? Hi, I'm Megan Yakoveski from Scotia Wealth Management, and today we'll go over what's happening in the real estate market and what that means for you as an investor. The real estate market isn't crashing, but it's not booming either. The real estate market in Canada has been stagnated for a few years now, and we're starting to see a clear split between major cities like Toronto and Vancouver. Let's start with Toronto. Toronto is starting to show some signs of stability. Home sales are up about 7% year over year, marking the second straight month of growth. We're also starting to see new listings being absorbed a little bit more quickly, which is tightening conditions slightly. Before prices can move higher, supply needs to get worked through. But even with that improvement, prices are still roughly 20% below their peak in 2022. And with mortgage rates still sitting between around 4 to 5%, affordability continues to be a challenge. At this point, there isn't a strong expectation that the Bank of Canada will cut rates meaningfully this year, so we may not see a sharp rebound in pricing in the short term. Now compare that to Vancouver. Vancouver is telling a very different story. Home sales are actually down about 2.5% year over year and sitting well below the long-term average. At the same time, inventory is building, with active levels still 38% above normal levels. So right now, there's simply more supply than buyers. You're seeing people list their homes, but not necessarily sell them. And until that excess inventory gets absorbed, it's hard for prices to stabilize or move higher in a meaningful way. So what's driving this? At a high level, both markets are still adjusting to a higher rate environment. Borrowing costs remain elevated compared to what people are used to seeing during the pandemic years. Affordability is tighter and buyer confidence is more cautious. Activity has slowed, especially in the condo market. At the same time, long-term fundamentals haven't changed. We still have population growth, limited housing supply, and ongoing demand. So what we're really seeing is a market that's working through a slower phase. While real estate has been working through this adjustment, the stock market has already moved on. Since the 2022 lows, markets are up roughly 60%. And this highlights something that's often overlooked. Real estate downturns tend to move more slowly and often last longer. A lot of people feel like real estate is less volatile, but in reality, it's just less visible. With an investment portfolio, you can log online any day and see the value move. With real estate, that same volatility is happening. You just don't see it unless you're actively buying or selling. The value only really feels real when you transact. And this is where the conversation becomes bigger than just the market. I always tell clients, it absolutely makes sense to own your principal residence. But when it comes to investment properties, it's not as straightforward. Because real estate isn't just about the market, it's about how it fits into your lifestyle. So whether you're already own an investment property or you're thinking about getting into the market, it's important to step back and ask, is this the most efficient way to build and manage your wealth today? And has your situation and the environment changed?